The future growth is, like I said, small town USA, rural, for any kind of income property. No longer coastal areas, no longer mountain and lake, no longer suburban, no longer urban, which is close to the inner core of the metro like downtown. No, these prices are too expensive to cash flow urban. Similar to suburban, similar to mountain lake, similar to coastal areas, these similar to mid-sized cities inside the mid-sized cities. These properties are very expensive. You can't cash flow under any asset class circumstance. STR, MTR, LTR does not matter. That's why you go deeper into the exurb, beyond the suburb, 1 hour or more away from major metro. That is the new way to invest in real estate, in my humble personal opinion. More town, cities, rural, far away, go to the path of growth, go to the emerging market, far away from the inner core, because those areas are more affordable prices, simply, and growing. Small town USA, here we come. And here are some of the cities. You pause this slideshow on your own. See, you see high costs associated by a short-term rental. Some of the market like 1 to 5 million, 750 to a million to buy a performing short-term rental. They are not cheap. Here are the cities. This is a study by AirDNA. They are the research and marketing consulting firm that caters to short-term rental landlords across the country. Tells you what city are good for short-term rental, maybe even mid-term rental, and what are the metrics. I'm not going to go over that. You read about it on your own. You Google AirDNA and their website and their research methodology. And if short-term rental is your cup of tea, by all means, do your work, do your research, do your due diligence. So if you make more than 150K, everything will be suspended, or your passive losses cannot exceed your passive income, and you have to carry forward to offset against future passive income. So here's some additional properties you can purchase in the various markets. Some property, this is mostly long-term rental. You can buy in the Midwest somewhere, Niagara Falls. You can buy a single-family home for $86,000, turnkey. Older property, but it's been rehabbed nicely, turnkey. It's good performing, of course. Very high cash flow, you see. But there are some maintenance issues with a C class, C plus class neighborhood location. Some of you may not like that. Yeah, you have more maintenance and more upkeep compared to a new construction. The cost is low, the down payment is low, is more cash flow, but less appreciation in this kind of blue collar, working class neighborhood along the Midwest. If you want high cash flow properties, that's where you go. But if you want cash flow plus appreciation in better location, better neighborhood, the property costs more. You need more down payment. And the cash flow is not as high compared to the low-cost market, which I just showed you, but the appreciation potential is greater. So you buy based on your specific criteria, based on your goals and objectives, your capital resources, to determine whether you want to buy much cheaper properties for high cash flow in the Midwest market, or more expensive properties, better location, better tenants, new construction, higher costs, obviously, and higher down payment, higher capital requirement, which you may or may not have available to do it. But the cash flow may not be that high, but the appreciation potential is very high. And that's the value of buying new construction, because, hey, we talk about equity. When you have an equity growth opportunity that trumps any other type of metrics you try to analyze for yourself. So equity growth, appreciation potential is clearly the best way to achieve wealth and buy new constructions in good locations in Florida, Texas, Alabama, and Tennessee, and Oklahoma is the areas where new construction path of growth small town USA, similar to this kind of numbers right here, South Texas right here, is also very ideal for cash flow and appreciation. And this is Florida. This is brand new fourplex. For this price, 25% down payment will give you cash flow. In Jacksonville, there's a very good, robust market. So you can fourplex brand new for almost $1 million. That's right. 25% down payment. Down payment amount $272,000. If you have $272,000 cash for down payment to buy this brand new fourplex in Jacksonville, Florida, by all means, do your due diligence. At the end of the day, you have a monthly cash flow of $1,190 first year monthly net cash flow projection. The three property which I identify, I'm going to use it as an example to go through an illustration to go over the impact of the tax savings by applying some advanced strategies tax-wise, which I will about to show you. All right. So here it is, the Buffalo property, the $86,000 property I just showed you on the previous screen. Don't worry about it. Annual net gross rent is gross rent, which is right here. Property A, which is right here, Niagara Falls, New York. Property B, the gross rent is the Edinburgh, Texas, fourplex, South Texas, which I just show you the pro forma. I just plug the pro forma into the Schedule E tax form, and then the property C is the Jacksonville $989,000 fourplex brand new, which is gross rent annually. Is this amount? Everything, I just plug it in. There's a method to my madness. I'm going to illustrate the case study of how the tax impact these kind of properties, this real world property, real world tax strategies. This is real. My investors have purchased this kind of property, and I'm going to apply the tax strategies I just shared with you, and then some, so you can see from the tax return perspective the type of tax benefit you can achieve if you apply certain rules. Am I right or wrong? All right, so here's the benchmark. Let's look at the item. Line item 18 is the depreciation. Line IT 18 is the most important. All the other expenses are pretty much giving, if you will. They already factor in easily from the pro forma. So here's the net cash flow or passive loss or negative cash flow. But I'll get back into this form momentarily. So this is a active participation rule, which I told you earlier. We already went through this example, but shows the cost segregation study because we have to do a 3, 5, 7, 10-year acceleration from that same fourplex. The cost segregation study allow you to achieve $28,000 of depreciation. So that's the benefit associated with cost seg. Instead of 15,854 on the traditional straight line 27 heavy write-off, when you do cost seg, your paper loss as a result of the cost seg study is almost twice the amount of the original depreciation write-off on a straight line 27 and a half. So a result, getting another extra 15 grand on top of that. Therefore, your paper loss is double the amount of the other scenario. You get $24,000 of pure tax write-off from the cost seg. If you make 100 grand or less, you're able to deduct maximum per year 25,000. In this case, you pretty much barely meet the threshold of a slightly less than 25 grand. So therefore, this entire 24,068, as a result of the cost seg study, can offset against 100 grand of AGI, adjusted gross income. So that will further reduce your tax savings on a dollar for dollar basis. Use a cost segregation study. So you got a 24 grand passive losses. Let's do the math. 24 grand multiplied by 25% tax bracket. So you save $6,000 total. $6,000 of pure dollar for dollar savings instead of $4,000 from here. Remember, you're getting $6,000 pure savings add incorporate the $6,000 dollar for dollar savings using a cost seg on this fourplex property. That's a huge savings on top of your end of the first year appreciation and cash flow increases and the principal debt breakdown. You see the total ROI in this case with a cost seg study. Without a cost seg study, the total return on investment is 30%. We went over that. But in this case, it'll be like 35% total return on investment at the end of first year with the cost seg. 35% return. Mutual funds or stocks and bonds will give you 3 to 5%, maybe 8% in any given year. But using the income property with the applicable advanced tax saving strategies, which I already showed you so far, you're getting a 35%, sometimes even a 40% return on your money, because the return on your money comes from the down payment. But your tax deductions is based on the purchase price. But you're not paying the purchase price. You're just paying the down payment, which is 1/4 lower than the purchase price. But your basis for your depreciation comes from the full purchase price. Do you understand where I'm coming from? It's the best of both worlds. What other asset class will give you this totality of returns, the multiple layers return? Do you clearly understand up to this point the value of become a successful real estate investor? But there's more. But wait, there's more. I sound like an infomercial. But wait, there's more. What is more? One more strategy, which I'm going to share with you, then we're almost done. Believe it or not, right now it's 8 o'clock. We're done at 9 o'clock. So, no, we still got time. All right. So, what other advanced strategies you can even fathom to learn? So far, have you not learned a lot? I hope so. Once again, if you have insufficient rental properties at this moment in time watching, it behooves you, if you have the available capital for more down payment, to buy more rental properties. The more rental property you can buy, the more tax savings you can achieve per my presentation tonight. And on top of all other returns, if you buy in the right market, if you find the right team to help you buy this kind of property I've been showing you, if it is out there, the resources are out there to help you. You don't have to do it alone. I digress. This is a federal 1040 form. The key is your W-2 income. As you can see, is right here. Income, W-2 income on line 1A. Let's say you have a high income scenario. You make $500,000 W-2. You work in Silicon Valley. I live in the Bay Area for a long time. I know a lot of friends that are earning $500,000 working for the major high-tech firms in San Jose and the Bay Area. So $500,000 is not unrealistic at all. So if you have high W-2 income, how are you going to save money? You are on the highest tax bracket, 37% federal or 12.1 or whatever percent state of California, and few other. You have been hit almost half. If you do not do the proper tax planning, almost half of your paycheck will be gone to taxes if you don't. That's why you attended my class. That's why I've taught you 75% of what you need to learn. But there's one last component you could qualify for. You don't have to. Everything I've taught you so far is very sufficient for you to drastically reduce your W-2 income subject to taxation. That could bring your $500,000 W-2 salary down to a 10 to 15% marginal tax bracket. With that, not be ideal? Would that not be amazing? Do not sign up for this tax strategy? Oh, yes, you would. Do whatever is necessary to reduce your top federal tax bracket 37% and to stick to California. If in fact you live in California, another 10%. We're talking 47% or more of your hard earned between paycheck are going to Uncle Sam. Are you kidding me? This is the basis. I'm using this example to show another case study, real life practical case study, which I have done firsthand, real life experience, coaching my students over the years, have very similar profile that I'm going to show you on this case study. The case study comes from real life example. This is not theoretical BS. I have a whole bunch of real life case studies to go over all kind of scenarios over the years. So tons of people are able to make so much money real estate long term. It could be you as well. It could be you. You have to be motivated. You have to want it really bad. Your $500,000 of W-2, as you go through the tax form, you go through all the supporting tax forms, you at various stages of the various tax form, you get more deductions line by line. Ultimately, the ultimate goal is to pay as little tax as possible. You see the second form of federal 1040. And the final component that I'm going to teach you, oh, I'm so mentally exhausted. The holy grail of tax benefit is real estate professional status, otherwise known as REPS. REPS. When I say the word REPS, is real estate professional status. When I say real estate professional status, I'm not saying you have to be a real estate professional. No. You don't have to be a licensed realtor. No. You don't have to be a real estate broker. No, which I am. At one time, I applied this rule successfully. Years and years ago, over the blue yonder. Anyway, so this is a tax definition. Real estate professional status, section 469 of the IRS code. Although you don't have to be a high income earner to qualify, but ideally, you have very high income, as I alluded to you earlier. If you make 500 grand, 400 grand, 800,000, if you're a successful business owner, making tons of money, if you're a doctor and lawyer or medical professional or whatever, making tons of money, using real estate as a hedge against your taxes is ideal. You could make a lot less money, 100 grand, 200 grand, and you can still use the real estate professional tax status. Same intent. Real estate pro status, let me give you a layman's definition, or I could bore you with technical details about the actual IRS tax code about real estate professional status. But let's make it simple so I can lay it out in layman's terms so you can understand what I'm talking about. If I were a real CPA, I will talk all over your head, perhaps, with all the technical terms and terminology, and I would have put you to sleep. That's not my goal.